with problems in the Eurozone.
Yes,
Quickly.
it's a seamless segue, isn't it, from butterflies to bailouts. It's another dramatic week in the Eurozone. Ministers are trying to sort out that second bailout for Greece. Will it go through? Meanwhile, Irish debt has been downgraded to junk status, meaning Ireland's unlikely to be able to raise cash on the money markets and could have to ask the EU for even more support. And as the IMF fires off a warning to Italy about its spiralling debt, could it too need an emergency bailout? Well, let's look at the figures. Italian debt is running at 120% of GDP, not too far behind Greece at 143%. The yield on Italian 10-year bonds, that's how much it costs the Italian government to raise money on the open market, rose to 5.8% on Monday. Now that compares to under 3% for Germany. Italy's biggest stock exchange, the Borsa Italiana in Milan, closed on Monday down 4%, with the biggest sell-off coming from banking stocks. And all of this is taking its toll on the euro. It's fallen to a 4-month low against the dollar of $1.38. Well, with me now is the independent economist, Greene. Good morning, Megan. What has happened now to throw Italy in the spotlight?
There's been a political spat between Prime Minister Berlusconi and the Finance Minister Tremonti over an austerity package that's been tabled in Parliament, with Berlusconi seeming to really undermine the package and to undermine his Finance Minister, Mr. Tremonti, who's really been the architect of austerity and has been a pillar of sort of fiscal responsibility in Italy. Also, at the EU level, we were just hearing a cacophony of voices coming from EU leaders. It's hard to figure out when they're even meeting, let alone to sift through the rumor mill about what they're discussing. So EU leaders haven't really shown any cohesion, and that's really worrying investors.
Yeah, it's been a dramatic week, hasn't it? We've got Italian ministers leaving the talks about the Greek bailout to go and sort out their own mess. Italy's being described as too big to fail but too big to save. Is it, do you think? And could this mean the end of the euro?
Yeah, no, that's absolutely right. Italy is too big to bail out. And, if it were to default on its debt, its public debt levels are the third largest in the world, behind only the US and Japan. So if Italy were to need a bailout, the Eurozone simply can't afford it, but also a default would be detrimental for the euro. And Italy's fate is really inextricably linked with that of Spain. And Spain and Italy together are just definitely way too big for EU leaders to be able to bail out, and that could mark the end of the Eurozone.
So just further knock on there. And what about for the UK? I mean, if Greece needs a bailout, I mean, that has some effect on us, but with Italy, it's a bigger impact, isn't it?
That's right. Italy's banking sector is far larger and more internationally linked than that of Greece or of Portugal. So the UK's exposure to the Italian banking sector is about 80 billion euros. It's fairly big. It's not quite as big as the UK's exposure to the Irish banking sector, though. But anything really that's going to threaten the potential existence of the Eurozone is going to impact the UK hugely, as the UK is trying to stage its economic recovery on the back of, a shift towards exports, and overwhelmingly most of the UK's exports are going to the Eurozone.
OK, so one to watch, Megan. Thanks very much. I'll be back with more on that and also news on how high street giant Marks and Spencer's has been faring. So I'll see you after 7.
All right.